And thank you guys for having me again. It's a great opportunity, and I look forward to running through what we're looking at things for this troublesome seasonal period of the market. To give you a little rundown of the seasonality that we overlay in our investment strategies. One of the things that realize or that we try to, share with people or tell them about is that, these seminars, these webinars that I do is pretty much how to use the Stock Traders Almanac, which we'll hold up a picture of. And in addition to the seasonals, we have these 5 market disciplines: psychology, fundamental, technical, monetary, which includes, politics and that sort of stuff, and the seasonal. So finding solid old school fundamentals and technicals with proven historical patterns has proven to be quite successful for our brand of investing and trading. And I'm going to give you a run through that. Here we are in a typical post-election year, July, with the VIX low and sentiment high. Stocks are up, and the time is nigh for a very usual August to September type of correction. Worst 2 months of the year. August is the worst in post-election years, and I'll show you some of the things we're looking at and how we prepare and how we've already been prepared for that. So first, just a word from the lawyers. This is for informational purposes only. It's not an offer to buy or sell any securities. Past performance does not guarantee future results. Do your own due diligence. Use your common sense. Consult with your advisors, etc., so forth. So we're proudly celebrating our 50th anniversary of the Stock Traders Almanac, and we've all, myself included, been standing on the shoulders of a giant. My illustrious father, Yale Hirsch, who started the Almanac back in, started the company, Hirsch organization, back in '66, came out with the first edition in '67. That was the '68 edition. And to be around that long is a testament to the value and efficacy of our work and the study. And, as Isaac Newton says, if I have seen further, it is by standing on the shoulders of giants, and that giant here is Yale. He's going to be 94 in October. Not quite as sharp as he used to be, but still around, and get to see him frequently. So it's one of the things that Yale, put on the Wall Street map with this iconic work that he put out was the seasonal patterns of the market. There were a few dabblers over the years. There's the political cycle, the 4-year cycle, but he really put it on the Wall Street map, and it's been on the desks of top traders and money managers for 50 years. We've sold, tens of thousands of copies a year, over 1 million in the 50 years. The 51st edition is at the press or with the publisher. We're proofing, so we'll have that out in October. And we're also putting out another Commodity Traders Almanac, which we're going to be self-publishing that because Wiley didn't want to do it anymore. So we've got a lot of good things going out there, but let's look at the service that we have and what we've been offering people up and the ideas we've been giving people recently. Just a little history here. As you can see, here's the first '68 Almanac, the 2017 I just showed you. The Almanac Investor book that I put out back in '06, which still is in print, or it gets print to order on Amazon. The wonderful title from Yale back in the '80s when he first put out "Don't Sell Stocks on Mondays," which is taken right out of the Almanac. The weekly patterns. My Super Boom forecast and book, which came out in 2011 from a forecast we did in 2010, which I'm not going to burden you with today. It's kind of heavy, but back when we put it out at around 10,000 Dow in May 2010, people thought we were kind of crazy, but now up at 21, almost 22, it's looking pretty attainable, and it works out pretty well with the long-term cycle that Yale identified back in the 70s with his forecast at 3420, and you'll see a little bit of that in a second. And of course, my little book of Stock Market Cycles, which has been pretty well received. It's a nice sort of sophisticated book for dummies, where we talk about all the cycles in a nice, concise, entertaining way. And then, of course, I get the pleasure to, appear on all sorts of financial media outlets, and we get picked up from time to time, and it's a source of pride for us. A little shot of me and the big guy. That's me, the shorter one with a little bit more hair. This is about 13 years ago when we were working together, and I was learning at his feet. and working with him up close. Here's a shot of Yale on Wall Street week with Louis Rukeyser back after he made that illustrious forecast of Dow 3420 by 1990 back in 76, which was pretty much a bullseye. The S&P made the 500% move by July of 1990. Dow did not hit 3420, until July 92. July 1990 for the S&P, May 92 for the Dow on that. Just to give you a little offer that we've put up here for our service. You can get the Almanac and do things yourself, but in our digital newsletter, the Almanac Investor, we put out weekly research and analysis with specific signals and alerts, buy and sell signals, buy limits and stop losses, including stocks and ETFs. You always get a free copy of the Stock Traders Almanac, and with this offer, you can save up to 57%. You use our promo code for the 1 year for $150 in honor of the 50th anniversary of IIMOM. That's for investor inspiration, masters of the market. One for 1 year, and for the 2 years, it's IIMOM2. And it includes a copy of the 2017 50th anniversary while we have supplies. We're getting close to the new one coming out. I also do private one-on-one mentoring, and as was mentioned in my bio, institutional research consulting with trend analysis, equity indices, sector rotation, and stock selection. Our philosophy, those who study market history are bound to profit from it, is taken from the famous George Santayana quote that those who fail to remember the past are condemned to repeat it. As I said, we think that those who study market history are bound to profit from it. But we want to make sure that we keep our buddy Sam Stovall's wise words in our mind, that we use history as a guide, not as gospel. Our process, for the years we've been analyzing and researching and testing every trend imaginable. We publish the findings annually, we update weekly and monthly, and we construct portfolios for institutions as well as help individuals do that. And first, our bias is from a seasonal historical perspective. We generally start from cycles and seasonals and recurring patterns, but we always have an eye on current trends in the economy, interest rates, monetary policy, other technology trends and commodity trends, and what's going on around the world, along with a big focus on market internals and sentiment. And then when we drill down into individual stocks, get into a lot of old school fundamentals and technicals, and I'll show you some of the results and some of the stocks that have come through our screens that we do provide as ideas for our subscribers. The major cycles, which we're not going to get into most of them today, we're going to stick to the worst 4 months, but war and peace in the secular bull and bear markets, that's the focus of that super boom forecast, the 500% moves, following war and inflation. And of course, a functional political environment and what we call a new enabling, culturally enabling paradigm shifting technology, like the microprocessor, the automobile, indoor plumbing, those types of things that changed the world and touched everyone individually and collectively over the years. The seasonal cycles is our bread and butter. You've heard about sell in May and go away. Well, we're well beyond that. We don't just sell in May and go away. We buy in October and get ourselves sober. Just a little pun or a little joke to keep it light, but basically we use the seasonal patterns with technical analysis and fundamentals to get in and out of stocks, sectors, and the market, improving returns, and I'll show you some of those results. We do combine sectors and commodities with using ETFs and other things. Of course, traders who have their own option strategies, future strategies, are keen on using our underlying analysis to implement the strategies that work for them. We do rely also on a lot of the quarterly, monthly, weekly, and daily, and even intraday patterns, especially when we're trading a position or getting in and out of something. It's pretty interesting. The one thing that's really amazed me is despite all this HFT and algo trading, the intraday pattern still persists, and you can find that on pages, I think it's 139 and 140 of the Stock Traders Almanac. We can see markets open all the week, rally, soften up before lunch, rally again, and then there's that 230 week period, and then rally towards the close for the most part. January indicators, Yale's the inventor, creator of the Stock Traders, January barometer, plus we combine the Santa Claus rally and the first 5 days in this January indicator trifecta, and overlaid with the Post-election year, it's pretty strong, and we'll have a look at that chart in just a moment. Just to give you an idea what we were thinking back in December when we put out our annual forecast, just the Thursday before Christmas, like we always do. We had a 3-case scenario. We gave the worst case about a 5% chance, complete letdown from the new president, and economy rolls in recession. We have a mild bear market. Base case, give it a 65% chance initially. We've upped that to about 70-75%, where he's got some moderate success, little real change, which is what we've seen so far. There's been some compromise and a lot of just bumping up against the walls and not making a whole lot of progress. Economic growth still remains a little tepid, and we're still looking at single digits to low double-digit gains. The best case scenario, that's no longer a 30% chance. That's more like 20, 15, 25, depending upon where you are. We haven't seen this big success. I guess the one thing that's occurred is the trimming of some regulations that seems to be helping the business climate somewhat, but no tax reform, no healthcare reform, and nothing on the infrastructure build out as of yet. And if that does happen, we some economic acceleration, and but that remains to be seen, and we don't think we're going to get those kinds of upwards of high double-digit 20% gains. So here's this one-year seasonal pattern of the January indicator trifecta combined with post-election years and first-year Republicans. You can see in the red line here is 2017. It's tracking this black line, positive trifecta years. That's where the January barometer is up, Santa Claus rally is up and it exists, and the first 5 days are up. And you have the blue line here, which is just all post-election years, and the purple line is a combination of post-election years that had a positive trifecta, and of course the bottom is the first-year Republicans. So you can see 2017 tracking closely a little bit below big number average up here, which is about a 24% gain when you combine the positive January indicators post-election year. We're looking for some sort of correction, sideways pause in the market remains to be seen. This typical post-election year July, which you'll get a little look at, is indicating that we're going to get a typical August, September, where there's some weakness and setbacks there. So this is sort of one of our driving tracks of the market, and we've continued to stay above the line. That's why we've remained pretty positive despite taking some risk off when we got our sell signals in May and June. Just to give you a little idea of the market at a glance, this is something that people find. This is the 5 disciplines, updating that for the newsletter that goes out today. Here's the one from last month. I'm not going to go through the whole thing, but if you get a glimpse of it, and you can always check out our website at stocktradersalmanac.com and get yourself a free 7-day trial there. You try to log into one of these things, but you can see how we run through the psychology, fundamentals, monetary policy, the technicals and seasonals, and it's a pretty solid guiding force for us. So the bread and butter, the big thing that we do is these one-year seasonal patterns where we see where the market has most of its gains. We try to be in the market during the time of year when the market's most likely to go up and has gone up over the years. And I see a couple questions coming in here. I think I'm gonna try to answer them all at the end. If you want to let me know if you want me to stop, I'll go in there. But yeah, let's just get to them at the end. Keep rolling here. So this one-year seasonal pattern, and I do appreciate the questions, shows the Dow Jones Industrial since 1901, and we've gotten the black line is 1950 to 2016. You can see that my email's popping up there. Sorry about that. And since the 87 crash, the green line, we like to compare ancient history or longer history with more current time frame and make sure that the pattern still exists. And we'll even go as short as a 20-21 year period. So I don't think that much can really is statistically significant if you go shorter than that within the stock market. And then the difference is, and why we sort of every year have to, or like to battle the people that try to debunk the best 6 months switching strategy, is that since from 1901 to 49, it was a flip side, reverse of this strategy. It was basically buy in May and go and rally through the harvest pretty much. This is an agrarian society chart. This is cash flows and money coming into the economy with the buying of fertilizers and seeds and equipment and fuels and hiring and all the activity that was needed to run the agrarian economy that we had in the first part of the last century. And we see that flips pretty much around World War II with the military-industrial complex and the service industry. So this just kind of shows us, that our analysis exists and continues to persist for the best 6 month switching strategy. And let's see if we can give you a little insight to how that works and what the benefits of it are. We had it run through the evidence-based analysis by David Aronson, who put out a book by the same name, Evidence-Based Technical Analysis in 08. It was our best investment book of the year. And when we were reviewing the book, we asked him to run the best 6 months, worst 6 months through the paces. And he ran it starting in 87 after we had published it first in the 86 Almanac. And he found that unlike the other 6,000 plus black box systems that he tested, it was able to disprove the null hypothesis, what they call the scientific method, and was proven to have predictive power, and the results were not the result of chance. And you can see the Dow average is about 7% in the best 6 months versus minus 0.02%, just kind of flat in May through October. Very prone to corrections there. Whereas in the a $10,000 investment and compounded since 1950. In the best months, it compounds to $843,000 gain and a loss of 116. However, overlaying that with our MACD indicators, and we use a couple of different MACD indicators. One for the buy side, which you'll see in a chart in a minute. It's the 817.9, comes right out of Jerry Appel's original research, and it's sort of the shorter or faster MACD. That are on the buy side, and the sell side we use the 1226.9, which is one that most people use, it's a little bit longer or slower, basically under the guise that tops are processed, take a little bit longer, bottoms are more of an event and happening more quickly. So the returns increased to 8.9% in the best months. The loss expands to minus 1.6. The gains of the compounding $10,000, the power compounding very, very apparent here, almost triples to $500,000, cost of about $6,600. Excuse me. So one of the keys to investing, and it really is very useful in our best 6 month switching strategy. People ask me, what's the one thing you would tell anybody who's getting into the market or the key to investing? And it's really to go against human emotion and admit you're wrong. Sell your losers short, let your winners ride, and that's exactly what we do in May, or when we get our sell signal using the MACD. Sometimes it's earlier in April, and we also have a different switching strategy with the NASDAQ, which goes 8 months, and we'll show you that in a second too. So we do sell some things in May, but we don't go away. We'll look to short some stocks. We'll stay long. Our big performers, especially the stocks that we pick, we'll get in and out of some of the ETFs, some that are better for the worst 6 months. And it's basically a switch from aggressive to defensive. And yes, you're at liberty to use options and leverage and other indicators, things like the advanced decline line, and help confirm a buy or sell or an opportunity there. And there's a little story of my buddy John Person. When I was down there doing the commodity almanac with him at his place, he was trading. I think it was back in 2012 when we did the last commodity almanac in 2013. For anyone that came on, we're putting out a new one for 2018. He was trading looking at the Russell 2000 right around April as we're getting into the worst 6 months period, the end of the best 6 months, and he was watching the Russell 2000 go up and the advanced decline line going lower of the Russell 2000, and he put on a vertical bull call spread on the triple inverse Russell, which is the TZX if memory serves right, and it was around 14 or 15 or something. He bought a 16, sold an 18 of the May contracts, and came in there, closed it out a few weeks later for a nice gain of, you know, high percentages, under a double, but up in the like 70, 80 period, 80% area, if I remember correctly. So that's sort of our strategy. We'll pick stocks in August, September, October after a dip going long. We'll look for stocks to short, and we'll talk a little bit about our criteria for that once we get into, you know, down the show a little bit further. So here's the recent S&P chart using Trade Navigator, which we like. It's got some seasonal stuff in there that we like, that's useful for us, and you can draw some circles and arrows on there. So our buy signal back in October, a little bit of drawdown there into that election that we had. Got our crossover in the 817.9 MACD buy signal buy indicator there, and a nice 9.5% gain in the S&P. Sell signal, the crossover the other way on the 1226.9, and in addition to buy crossover, the sell crossover, we want to make sure that when the buy is buying, the sell isn't selling, and vice versa. When the sell is selling, the buy isn't buying. We also want agreement across the indices that we're tracking. So on the buy side here, it would be NASDAQ, Dow, and S&P. On the sell here for the best 6 months of Dow and S&P, we'll just use the two of those. And then the NASDAQ, which has a best 8 months switching strategy, which has done really well. We look for that sell signal coming in after June. And here you can see the buy in October at around 53.09. Nice, nearly 17% gain. Our sell signal in June, yeah, we've a little bit higher than that right now, but not a whole lot. And it's okay. We don't expect to call tops and bottoms, and we're not pigs. And we try to just be smart about it. And this is what's worked for us, compounded over the years. So you can see the sell signal crossover pretty clear, June 9th. And I'm from here from the buy side. So just to give you an example from one of our you know, devout followers here, Rick Canfield's been kind enough to share his thoughts with us. He uses his IRA for this trade, and the amount of money that he's making here is worth so many times the cost of the subscription. I had to show everyone. So back in October of 2016, he got our buy signal. He bought the Qs for 119. Sold it in June for 139. 17% return resulted in a profit of $340,000 traded in his IRA. Back here, 2 years before that, he bought the Qs in October 4th. October 14 was a great buy at 98. Waited for the sell signal in June. 05. So he's pretty comfortable with his $200 a year subscription, or actually you see the special deal for $150 with the promo codes that I gave you. Just a little insight into a happy camper who uses our service and is making a good solid return just with a couple of trades a year on one of our strategies. But here we are in the worst 4 months. July is a little bit better here, especially in election years. But this is week period we're looking for, and this is all years, not just post-election. This is right out of back page in Stock Traders Almanac. I think it's 147 if memory serves. And just to give you an idea of what we're looking at, you get the best 6 or 8 months here from November, December, January, February, March. I know some of the big numbers here make these a little smaller than they are, but these are pretty solid gains. October's been a turnaround month now. We know about October phobia from us. So just to look at the July situation and where we are. So it's the best of the worst 4 months. It's the tops in post-election years, but after Christmas in July, which is what we're kind of experiencing right here, volume tends to dry up. People hit each and things are prone to correction. And then we're followed up with the worst 2 months back-to-back, August, September. August is also the worst in post-election years. And this is why we get defensive and start to take some risk off. So you can see the election year, post-election year, July ranks #1 for Dow and S&P, 2 for the other major industries we're watching. And see the kinds of gains we're getting right now, about 2% or so. The Dow and the S&P are right within keeping of the normal post-election year returns. That's got us thinking we're about ready, prime for a little bit of an August pullback. And especially the first 9 days of August are pretty weak. Then we tend to get a little bit of a mid-month pop there, and then the end of the month is usually quite weak. And then September is pretty volatile, especially around triple witching in the third quarter, and the week after is where there's pretty consistent period of negativity in that week after triple witching, and the end of Q3 with all the window dressing and portfolio restructuring that goes on ahead of the fourth quarter by the professionals out there. So here's that volume chart. See the green line for NASDAQ 1-year volume. This is 78 to 16. You can see we've got this sort of dry period in the July and August through Labor Day. We had this spike here back at the end of June when we had Comey hearings, Brexit scares, and a little sell-off of the FANGs. You can see volume spike there, and then it's returned right down here to these sort of low annual average levels, annual daily volume levels. And then we get into sectors. We do a lot of tactical sector rotation. Here's the rotation calendar out of the Stock Traders Almanac. I think this is off of page 92 for anyone that's got one or wants to look. And you can see most of the long sectors, so long trades come in October through, either the end of the year or the spring. You can see these short trades that start picking up more in the end of the year. The end of the best 6 months around May. This materials trade is something I'll show you. It's a pretty persistent short and long, and we'll just give that as an example in just a moment of how to go long the best months and short the worst months in a particular sector. And for perspective on some of the better sectors to trade in the worst 6 months, that's May through October, we've just listed all the sectors versus the S&P 500, the main sectors. And even though biotech up here is pretty strong, a big proponent of biotech for the future, but in the worst months, the plurality of gains and the median gains are quite weak. There's a couple of big years here that juice up the average, and we want to pick decent gains with a high plurality of up periods, like consumer staples, utilities are pretty solid, even information technology, and of course bonds here, which inverse relationship to stocks tend to go up when stocks go down. So if we get a break in the stock market, we should see a little pop in the bond market. Gold also is a place to be for safety, and we're in some of that stuff right now, and I'll show you the portfolio in just a moment. But first, the look at the seasonal pattern of the materials. You can see it's very similar to the best 6 months, a little more pronounced on the downside here. You've got from October or so through May, pretty much a rise. May through October, a pretty decent decline. And then using a similar comparison of the bar charts here, but this is a little different than best versus worst. This is our sector rotation strategy on the left side here. Long the best months for materials, short the worst months for materials versus buy and hold. A 15% gain versus a 5.3% gain, annualized performance there. And the compounding of that same $10,000 hypothetical investment, but back to 1990 only here, because that's when the data for this sector is pretty strong. At 10,000 gains 377, almost 378,000. Sector rotation on a long the best, short the worst versus buy and hold of $40,000. Almost a tenfold difference between the two buy and hold and sector rotation there. So here's our current portfolio, and just to explain, we've got the day we presented it, the price we got into it at, which was based on a buy limit for the most part usually. A few little red numbers here. Some of the shorts and worst 6 month stuff is going against us a little bit here, but you got to have a little patience. Dow Transports, you can see, is come back a bit. Dow Theory's taking a bit of a hit today. This was down about 166 or 165 I saw earlier. And you can see back in June when we got our NASDAQ sell signal, we sold a few of the technology shares. A little trade in the British pound here, which is seasonal based. That was just sort of the turn of the year repatriation of funds, the fiscal year for the United Kingdom. And we've always got a buy limit, a stop loss, and our auto sales kind of like a target price. It's pretty much about 10% over the historical average for the seasonal trade if it exists there. And right now we've got a couple of buys that we're putting out to that. Biotech makes a nice low around August, and that's when the new technology seasonality begins. So we're anticipating it a bit early, and these are a couple of trades that we just out for subscribers last week or 2 weeks ago. And just going to look at the stock selection process, which is pretty robust and pretty in depth. It's got an excellent history, and we like to use our seasonal overlay. So we're looking for at times, some sector seasonality and strength when we're going through our screens. We also let the screens tell us where it's finding strength. October, we're looking more for longs. Summer, we're looking for shorts, and we go through the Zacks research widget database, and we screen fundamentally. It's about 24 different criteria. We're looking for revenue growth and acceleration, earnings growth and acceleration, good margins, decent valuations with PEs, price to sales ratio, cash flows, debt, and ratings. And here's where we get a little wrinkle here. We find two stocks that, all things being equal, good valuations, good growth, good charts, sticking with the, not underperforming the market, not way outperforming it. But one of them's got 20 analysts following it, and another's got like a handful of them. We're going to go with the one that's got less. It's a little bit under the radar. We're not competing with the wirehouses with their analysis and their recommendations, and we're sort of getting in ahead of them. Then once we, whittle down the 8,000 stocks to about, 50 or so with sorts and screens, and look at some charts. Then we'll pick the ones that are looking most attractive, and we'll break them down by market cap. We'll give you some trading volume, and we look at the insider holdings. And on the short side, we basically invert it and look for companies that are breaking down with revenue growth and having deceleration, overvaluations, and that sort of thing. So it's pretty much a combination of old school technical analysis, fundamental analysis, seasonal overlay, and an observation of what the screens are telling us. We look for shorting at support, breaking through support, or failing at resistance. And that's where we pick some of our buy limits. We'll look at moving averages, pivot points, and good old-fashioned chart pattern recognition to pick a place for entry, a buy limit, and stop, and so an exit price. So we put out a short basket recently. Some of them have executed. You can see the ones with the little S by their name, that's the short. We've got our current advice over here. Buy limit if necessary, a stop loss. You can see holding on to some winners here. This copper trade that we do in December has brought us a couple of nice winners. We got Southern Copper from 2015 up 45.6%. Global Brass and Copper Holdings up almost 125%. Our big winner from last basket in last October, last September, we put it out in the large cap areas. Arista Networks, large caps for us are over 5 billion, mid caps 1 billion to 5, and small caps under 1 billion. And you can see some of the numbers that we have are pretty solid here. And a couple losers in there. We try to trim them at best. We have some patience with some of these things. We've got protective stop loss here. Hirsch was a chocolate-based trade, popped a little bit this morning, along with Rocky Mountain Chocolate Factory, a small cap chocolate company. So when seasonal prices of chocolate goes down, the makers of chocolate and the users of the raw material tend to go up. Not working out super great right now, but we're keeping an eye on that, and we'll cut that loss short if it doesn't continue to work for us. But over the long haul, and that's what really matters, is the performance of this portfolio since 2001. Our stock picks, using all the trading guidance and buy limits and stop losses that I have to share with you, up 423%. This is as of year end 2013. It's considerably higher now, pushing 450. S&P is also up about 100 now. So the green line's the S&P 500, up 83 over that same time frame. The Russell 2000 up 165. So you can see we're outpacing the market pretty consistently. There's been a couple of dips here. We didn't go down as much in the the 08 period, though we did take a little bit of a hit there. but sticking to the system over the long haul has produced some seriously solid gains. And just gonna sort of wrap things up a little bit here and get to some of these questions. So there is a bit of a setup for a summer pullback. We've got these investigations going on. The Fed has tightened. I don't think they're going to be tightening anything soon until December. We've also got this debt ceiling issue in Congress and in Washington that's not happening. There's some hotspots, Syria and Syria and those things a little quiet over the past couple of months, but you know that's been brewing all year. Everyone seems rather bullish. Sentiment is up pretty high, and we've gotten to that average time when the S&P 500 is had its 10% correction. So we're kind of due for that. Set up at the seasonal weak spot, and you know, it's just a time to be a little cautious. If anything, I would not be going long stocks right now. Maybe sell some puts if you want to get into some things, but for the most part, we're holding a bit of cash, hanging on to our winners, and have some downside hedges in place. As you can see back in that strategy with some of the gold and bonds that we have in there and the short trades that we've got on right now. So just a reminder, you know, what we try to do is put the information in the Stock Traders Almanac into knowledge in our newsletter, and use that wisdom to construct portfolios. The offer, as I shared with you before, you get a free copy of the almanacs every year. Pretty solid deal, $250 for 2 years. You saw the results that Mr. Canfield had in his portfolio with just a couple trades a year. You saw some of the numbers in the stocks that we trade. So, you know, you go to stocktradersalmanac.com and you take us up on this offer here, IIMOM1, IIMOM2 for 2 years. And if you want to kick the tires a little bit, there's a 7-day free trial. It gives you access to everything. And if you click on one of the, you know, alerts to see what we're writing about, you'll see a box that'll write that says sign up for a 7-day free trial. And anyone's interested in learning how to trade like this or invest like this, I'm available for one-on-ones. I also can talk about the rest of your portfolio pretty intelligently. And as I said, we do provide institutional research consulting. So with that, I'm going to open the floor up to questions. I'm going to go back in there and take a look at what was being asked as I was rambling along. So let's see. That's James. Leverage is incredible. Joe is going to extremely outside of the market. Please enter your phone number. Let's see. This is not for me yet. Anybody have another question out there? Dale, do you offer any comments? The other guy before me. What is the forecast? I like your presenting mode. Let's see, can we put us at 820? I like your presenting Jenny material. Okay, 2000 forecast from current levels. Well, our forecast is, you know, we're looking for a little bit of a pullback here, about, you know, 10% correction, maybe a little bit more, depending upon how ugly things get, or not ugly they get in Washington, and what comes out of the seasonal pullback. People can pile on there, and then we'll look for a rally into the close, maybe a slightly higher high, and also into the first quarter or so of 2018, which is when I think we become really prone to a serious market pullback, potentially one of those classic midterm bear markets. 2018 will be the midterm elections, and those sabers have already been rattling. The mud will start to fly, and people will be distracted from the market with the what promises to be a rather contentious midterm election period. And we look for some sort of perhaps even mild bear market, something in the 20 to 30% level, probably more around the low 20s, maybe even slightly lower, not your typical 20% bear market, but something we have used the Ned Davis research definition, which is a 13% correction over 145 calendar days, peak to trough in the Dow. There's a couple other things in there. So we'll look for, worst 4 months, bear market or near bear market low in 2018. And but for now, a little bit of a correction over the summer. As I said, 5 to 10% correction, and then a rally into the close, depending upon what happens with Trump and friends. And what's trifecta? Richard, the January barometer is as January goes, so go the years. It's something Yale Hirsch invented in '72. It gets talked about a lot, and it's an indication. And we've gone and debunked the people who question it, that what happens in January does have a good indication. There's a lot of things that go on there, namely new Congress is convening, states of the union, all of the analysts and strategists deciding where they're going to put their money in the market, people, individuals placing their bets, if you will. And we combine that full month January barometer on the S&P with the first 5 days, which is an early warning indicator. And the records of that are in the almanac, and some of it's on the website as well. But pretty solid results. Nothing's 100%. But combined together, the results improve dramatically. And then the third part of the trifecta is the Santa Claus rally, not the one that gets, talked about from Halloween through Valentine's Day, but the one that occurs that we defined also in '72 of the last 5 trading days of the year, plus the first 2 of the new year, which is usually time with light trading as people are celebrating holidays, and you have mostly floor traders and trading desk people and professionals coming in and buying up the oversold stocks for tax losses. And when we get a rally, we usually get a normal rally about 1.5% or so, nothing big over that 7-day period. But it doesn't come, as we coined the phrase in the almanac, if Santa Claus should fail to call, bears may come to Broaden Wall. And we've seen some pretty decent sell-offs in 2000, 2008. Some flat years in '94 and '04, and it's a pretty solid combination. And if anyone needs the slides, I don't know if they're sending them out. You can reach out to me if you want further information on any of this stuff. What investigations are going on? The Russia thing is BS. Well, I don't disagree with you, but it is. And I put out a blog post, which I guess I can show you in a second. Let me just see if I'll switch over there, and we'll go to this is my website over here. You can click on the alerts, and if you want to take out a free trial, if this thing internet will work, click on one of these things, and you will try to log in, and you get the 7-day free trial over here if you sign up there. But I want to show you this blog post I put out, which is up there on Tumblr, and we do a lot of nice things there. There's a typical mid-month pattern if you want to check that out. But the one I want to show you that I'm referring to is this Russia BS thing, which I don't disagree with. But I showed a chart of Nixon. I don't know if you guys can see that there. I can zoom in a little bit. Nixon's Watergate, sort of timeline points with the S&P 500 overlay. We have the break-in in June of '72. Nixon gets reelected. Watergate committee started, and then the Saturday Night Massacre market crumbles. Kind of not bullshit, right? And we compare it to the Clinton-Lewinsky scandal, which how unsavory it was. It still was kind of BS, if you will. And you can see Lewinsky subpoenaed. The judge report rumors the affair. The dates I pulled out. Ken Starr subpoenas Clinton. He agrees to testify. Clinton's the first sitting president to testify before grand jury after he admits the affair on national TV. Afterwards, he admits the affair. Then he's impeached and he's acquitted. And it's kind of nothing happens. The market continues to go up. Compare that to the current situation with a couple of data points, a couple of timeline things there. He gets elected. He fires Flynn, fires Comey, and here we are still climbing higher. So your assessment, Richard, is not unfounded and does have some sound. The auto sell is not 10% of the all-time high. It's 10%. We work it for any of our sector trades is about 10% of the average gain for the period we're looking at. The promo code, let me get that going for you as soon as I get this off. It may have not been set up. It'll take a second. I appreciate that. And here we are, just a few minutes ahead of time. I'm going to wrap it up, and I want to thank everyone for joining me. And that promo code will be up momentarily, so please that and trying to get everything done. So I appreciate that. So thanks everyone for coming. And if you have any other questions, please reach out to me through stocktradersalmanac.com.